As usual, you could get life insurance in as little as 5 minutes, link down below, and get one free stock worth up to $1,600. Just deposit $100 and they will give you up to $1,600 in a free stock. Hey everyone, me Kevin here. Have you ever heard of home flipping in real estate? You probably have. Somebody buys a house that needs some work for a super cheap price, fixes it up, and then turns around and sells it for a profit. Well, folks, we have a big IPO to announce that has to do with the iBuyer sector. iBuyers are companies like Zillow, Redfin, and Opendoor who will make you an offer on your house as is. Except that is much to the dismay of real estate investors like me who like to buy those fixer-uppers and flip them myself. After all, I have been a real estate investor and real estate agent since I was 18 years old. And folks, I love real estate. I have a real estate investing course, a property management course, and I'm starting to do real estate flipping vlogs. The first one comes out today. And between my wife Lauren and myself, we control over $16 million worth of real estate, and we're super excited to keep growing the portfolio. Well, today, legendary investor who pretty much just goes by Chamath, you can give that one a Google, we'll call him Chamath P, is announcing the merger of his $600 million blank check company known as a SPAC, a Special Purpose Acquisitions Company. And he's announcing this $600 million merger with Opendoor, one of the iBuyers, actually probably the biggest iBuyer right now. And this is huge. Let's break down what's going on in this video in terms of what's going on with Opendoor. What do we need to know? What do we got to pay attention to? And what should we be investing in? What does this have to do with Redfin and Zillow? Let's get right into it. So this is what Chamath said this morning when he announced the deal. He said, here's the scoop about real estate. The federal government is reducing SALT tax benefits. That's when you can write off state and local taxes. And that is causing people to move to lower cost of living areas to have a higher quality of life in less expensive areas. And he sees 75 million millennials who are starting to enter the housing market as Americans escape big cities and move to areas with lower costs of living. And basically, Chamath is trying to make Opendoor the Amazon of housing. Opendoor already claims to have reinvented how people buy and sell a home with a simple online, digital, and on-demand experience. And this partnership is going to give them the money that they need, providing an enterprise value for this Opendoor company of $4.8 billion, and it's expected to provide $1 billion in cash, so that way they can launch new products and accelerate Opendoor's plan to become a digital one-stop shop for homeowners. So again, this is a $600 million partnership. That is a private investment into public equity. That's what PIPE stands for. This is very, very similar to what we saw happen with Nikola. If you remember Nikola, you might remember that it used to be called Vecto IQ, which was basically a shell company, kind of a company that had IPO'd, but it never really did anything. And so a hedge fund basically came in and said, hey, we're going to do a SPAC here. We're going to take all this private money. We're going to merge a company like Nikola with this Vecto IQ company, change the branding, and boom, Nikola is now publicly listed. It's kind of the same thing they're doing with Opendoor. And the way it kind of works is you get somebody like Chamath who says, hey, I'm a really good investor. I got $600 million worth of backing, people who have written me checks and said, Chamath, you go invest it. And then he takes that $600 million and looks for a company and says, hey, Opendoor, I got 600 mil. You want us to help you go public? Partner with us. Let us invest in you. Let us merge with you. Let's bring you public. Pay me my fee, which for him, his fee is probably going to be like $100 to $120 million. So congratulations, Chamath. And generally, the first investors, if they make a good choice, they get good money. They get good pay out of it. I mean, think about the Nikola merger. When the Nikola SPAC merged and hit the market, the people, the PIPE investors, the PIPE investors, they got their shares for like $10 a share. Well, even after all the bad press, Nikola's at $33 a share right now. That's a pretty good return on your money. I mean, that's tripling your money, okay? So these PIPE investors make out like bandits. But the question here is, how can people like us benefit from this? How do we make money from this? Well, let's first understand a little bit more about how this this model works, and then let's talk about how we can benefit from this. All right, so we know the home flipping business. We get the concept. You buy low, you sell high. You fix up in between, you take the profit. Great. But why is it then that this company, Opendoor, has $4.7 billion in revenue? And with $4.7 billion in revenue, they only have a market cap of $4.8 billion. Like they're making 4.7, but they have a market cap of 4.8? That doesn't sound right. Anybody would just buy that company out all day long. Like Apple would go buy that company right away. But wait, the key is revenue, not profit. And these companies are very low profit businesses. They're very high revenue, very low profit, because they take the value of the houses. So what they'll say is, oh, well, we bought a house for $500,000 and we sold it for $600,000. Well, they call the 600 revenue. And then they call the fix up, the acquisition costs and all that expenses. So then it's like, oh crap, we spent $590,000 and we, made 600. So we made 10 grand. Like the numbers are inflated 100-fold because of the way real estate works and the way the flipping business works. So keep that in mind when you're looking at these numbers. They're very misleading because of that. But anyway, what I want to focus on right now is how this affects us. So here's what we got to do. The first thing we're going to do is we're going to look at Redfin. Look at Redfin 6 months ending June 30th. They got revenue from their home flipping business, which is called Products, right here on their latest quarterly report. In the last 6 months of 2020, they brought in $152 million, but they spent $153 million. So they're literally at 101% for their expense margin. That's not good. I'm gonna save you the boring chart for Zillow, but basically for Zillow, they spend 99.8%, which means they have a profit of 0.2% on their home flipping business. Those are not very good numbers, right? Like these companies haven't figured out how to go profitable yet. And the reason is construction is hard. Flipping is hard. And I made a Redfin analysis video 2 days ago, and I said, I think Redfin is a buy because of the growth they're going to have in this iBuyer world, in this home flipping world. And I think in the future, Redfin can get to a 5% margin where they have 95% expenses and 5% profit margin on these flips. And I got really excited by this. I had no idea that this SPAC was coming to give us a whole lot more information into this. You can still watch my Redfin video. It is 100% applicable. If anything, it's way more applicable now. But I was buying Redfin a lot and I increased my holdings in Redfin right before this. Now I'm potentially getting even more bullish on Redfin and Zillow. And let me show you exactly why. By the way, before I drop this hammer that I just discovered about Opendoor, I really want to show you this quickly as well. I showed you the profit margins on Zillow and Redfin here, but I didn't mention that Zillow in the 6 months ending 2020 actually got revenue of $122.4. That's $1.2 billion. And their expenses were 1.222. That's how I got to that 0.2% profit. Like very, very bad on the flipping side, right? And it's because construction is hard to scale. You have to, as these iBuyer programs, learn how to unlock the key of scaled remodeling. How do you coordinate contractors? How do you use the same products? How do you minimize the time it takes to do these remodels? How do you shorten the permit process with the cities? How do you, do all of this? Like all of that takes effort, and that's why the margins suck right now. Okay, here we go. These are their long-term margin targets, and I found this like at the end of their press releases at the bottom in a footnote somewhere. This is really, really, really good. So in 2018, they were bringing to the bottom line about 2.4% after their interest expenses. That went down in 2019 to about 0.6%. That's probably because Zillow and Redfin really ramped up their competition. Basically, what's happening is when people want an offer from these, they just shop Zillow and Redfin and Opendoor. And it makes sense because, why would you not shop it? Which squeezes the margins down even more. And these tech companies are willing to lose money, which is just It's painful. It's so painful. Now, in fairness, like I invest in Redfin, so it's not like it could be that painful, but still, it's like these margins are horrible. So quick note before I go to the next slide, what I want you to do is remember they've got 0.6% here for 2019, okay? Watch this. We're gonna go over to this other page here. Contribution after interest, so after their expenses, how much profit are they making on these properties? Here's that number again. See, here's 2019. Look right here. Here's 0.6, right? Look at their projections, folks, and these are just projections, so it's basically a bunch of baloney until it actually happens. But it tells us how to value Zillow, Redfin, and Opendoor right here, baby. I can't believe I just said right here, baby. I'm sorry, okay? I'm just excited by this. Look at this. 2020, they think they can get to 1.8% margin. By 2021, they think they can get to 3.3%. By 2022, they think they can get to 3.9%. And by 2023, they think they can get to 4.7% margin. Those seem like very small numbers, but they are huge, absolutely huge changes. And I'm gonna show you exactly why they're huge by pulling up the spreadsheet that we did on Redfin. And I highly encourage you watch, if you like this video, go watch the Redfin video, okay? This is what we looked at when we did the analysis on Redfin. And look at what I wrote here. This was before we even heard about this SPAC. Like, I did not change this. I'm glad I posted the video before. But the video is still totally relevant. But look what I wrote here. Huge, huge, huge. Margin here is what to pay attention to. Must improve. My guess, failure to systematize contractors right now, very difficult to scale. That's why the margin is low. So, margin is huge, but look at how huge it is. I did this projection, and I said, okay, let's look at the projection here. Let's scroll down. We've got a projection that maybe with a 40 times earnings ratio, Redfin could be worth $78 at the end of 2024. Honestly, it'll probably have a way higher PE ratio, and the stock will go up past that. But what I want you to do is look at that. You see the $78 right here. Watch what happens if I change this margin and they don't end up getting to 5% as a profit. So if I change this right here and we change this to, let's say, 99%, they're stuck at 1% for the next 4 years, their stock value based on this right here goes to crap. Okay, let's scroll down to the bottom. We hit enter. Look at that. It goes to $39 on a 40 times earnings ratio. Bad. It halves, basically. On the flip side, if they can be even more efficient at Redfin and they can exceed expectations, let's do it again. But this time, let's go ahead and punch in 90%, which I don't, honestly, no, they're not going to get to 90%. Let's put in 93%, okay? 40 times earnings. Let's go ahead and hit enter on that, jump on down. We get to almost $100 a share at Redfin. So you can see this minor little change on margin makes a huge change for Redfin, Zillow, and Opendoor. That's what you got to pay attention to if you're investing in these companies. Folks, this projection by Opendoor is literally right in line with what I thought Redfin was going to be able to do in 4 years. I said 5%. They're thinking 4.7% in 3 years. And this is before I even knew about this stuff. And I'm not trying to pat myself on the back. This is what I do for a living, is real estate. Like, I get this. Once you systematize it, you should be able to get to even more. Now, I know there are going to be some home flippers that are watching this like, oh, I'm at a 30% or whatever. It's different when you're at these massive scales and you got payrolled employees and all this, these massive companies. But this is really good. And we're going to see more and more, I think, of a bounce at Redfin and Zillow if these numbers hold true. If this S1 comes out bad and Opendoor's financials don't end up proving to live up to snuff, it's going to be bad for Redfin and Zillow as well. But for right now, I'm increasing my holdings in Redfin and Zillow. I changed the 1337 to V number 11. So you can go see my favorite stocks and the allocations right now by going to metkevin.com/1337V11. Thank you so much for watching. If you've enjoyed this, please consider sharing it. And folks, we'll see you next time.